Welcome to EWA's FIN-LYT podcast. EWA is a fee-only RIA based out of Pittsburgh, Pennsylvania. We hope all listeners of this podcast will benefit as we deep dive into complex financial topics that we will make simplified for you. And we hope that this really serves as a catalyst so that you can make the best financial planning decisions for your family and also save time. In today's podcast episode, Jamison and I are going to talk about what money is safe and what exactly does safety mean. I think there's a lot of misconceptions out there with the bank failure and potentially other banks' balance sheets and management styles coming under question, under the microscope. So today we're talking about specifically to our clients and all listeners on what of your balance sheet is technically safe, and even for safe money has certain risk to it. So we're going to really go into a deep dive here of what are all risks on the table and what does safety really mean. So Jamison, first, let's just talk really briefly on the banks, the failure, and what that means to our clients moving forward.
Yeah, I think this just the timing of this is really important based on the headlines with the banking failures and everything. And I think every, especially high net worth individuals, but most people want some sort of liquidity at all times, meaning no matter what situation, then they want something that they could access, no matter what's going on in the market. So having something there is really important. But recent headlines, high-level overview, there's been a couple of bank runs, which totally normal, has happened a bunch of times in history. But basically with rising interest rates, high-level banks have to have a portion of their assets backed by cash or cash equivalents or something that is safe, because just conceptually banks, if you put money into a checking account, they then turn around and lend that out in like a mortgage, for example. So if everything's lent out and everybody comes to the bank and wants their money back, that's what causes a bank run if they don't have the liquidity. So with rising interest rates, some of the banking failures, they had treasuries, which we'll hit on in great detail, which are safe, that were a low interest rate, and as interest rates rose, people came to get their money out of the bank, and they would have had to sell all the treasuries at a discount because new treasuries were being purchased at a much higher interest rate.
So let's simplify this really quickly for listeners. So if Matt, bought, let's say, $100,000 of treasuries last year, and I did that, it was a 5-year treasury for 2%. And then let's say Jamison this year has $100,000 of cash, and he's going to buy treasuries. Right now, he could buy a treasury close to paying, 4.5% to 5%. So the question is, well, if I need my money today and I'm 1 year into a 5-year treasury, 4 years left to go, if I have the bandwidth, the flexibility to stay in my treasury for all 5 years, I'm not losing any money, but I'm only getting paid 2%. Jamison, if he has the opportunity to buy a 4.5% treasury, and I try to sell him my 2%, there's no way he's going to buy it. So what would need to happen? He would offer me a discount to make up for the difference in the yield. And that's exactly what happened to the banks. The banks Silicon Valley, for example, they purchased a ton, billions of dollars of treasuries paying under 2%. And that's a very safe investment. But if the bank doesn't have the flexibility to see that duration, that maturity come to fruition, and people come and try to get their money now, the bank would have to go out, and they did. They sold those at a big loss, which is what is the safest investment, one of the safest investments that exists is treasuries.
If held for the duration.
If held for the duration, ended up being what caused the failure ultimately.
And then, high level, total mismanagement, but then at the same time, just to put into perspective, their assets were like $200 billion, and $80 billion, like almost half, was in these low interest treasuries. They also work with primarily tech startups. So we think about what happened is going on right now in tech. It's really hard to get funding. Obviously, like tech industry has suffered. So tech companies that can't get funding from VCs or private equity, they have to use cash that's in the bank. And so when all of these companies are now drawing on the cash and they have half of their assets locked up in low interest treasuries, it's impossible to come up with everything. Was high level basically what happened. So
okay, perfect. So let's talk about what is safe and then what risk. So let's just talk about cash first. So let's talk about banks. So Jamison, what are the limits? Explain, what is FDIC? What is the limits? And if a client had $1 million in a bank account, is that safe, or how would they make that safe?
So FDIC insurance basically backs, it is insurance that backs depositors in banks, but it's only up to $250,000. So you could have 10 different accounts at 10 different banks and you get $250 each time. If you have $1 million in one bank account, only $250,000 is covered. And what that means is, just like Silicon Valley Bank, what happened if that bank totally went under, they got bailed out, not by the government, but by the FDIC backed the depositors. But if that bank totally went bankrupt, only $250,000 of that $1 million is safe, hypothetically.
So right off the bat, cash in the bank is technically safe from a principal, as long as you have $250 per registration. So that could be $250 I could have in a checking account, $250 in a savings account. I could have if you're married, you could have a joint name and $250 in each spouse's name. So it's per type of account as well. And so one workaround this, because we have some clients that they're sitting on millions of dollars of cash. So what we recommended is open up a brokerage account. And if you want that FDIC insurance, just purchase CDs with different banks inside the brokerage account. So that way, you're not physically going to a different bank. You can open up one brokerage account, let's say at Fidelity, and then purchase 10 CDs, $250 each, so you have $2.5 million. Boom! Immediately, that money is safe from a principal and a FDIC. If any one of those banks fails, technically the money's safe. So when we talk about cash, though, a lot of people think, okay, it's safe, like I'm not going to lose my principal. We also have to think about liquidity risk, which cash does not have, but then also inflation. So on a high level, if inflation, let's just say over the next 50 years averages to be 3% and banks pay you 1%, I'm just making this up, you're technically losing 2% a year. And if historically, money loses its value every 20 years by half. So meaning a cheeseburger that costs $1 now, you're going to need $2 20 years from now to purchase the same cheeseburger. So technically, if you keep money in a bank at $250 and you spread it all across, the money is safe. You're not going to see it go down, but you're actually losing you're almost losing half of your money every 20 years if that's what you do. So we do recommend that clients keep some safety net. But we generally recommend from a pure cash perspective, no more than, depending on the client, the cash flow and what they have going on, no more than 3 to 6 months of actual expenses in cash. Most of our clients have years of money that is liquid, but we'll talk about other ways to make that happen. I just first want to talk about cash. It's safe from one perspective, but it's not safe from a loss of purchasing power long term.
Yeah, no, that's totally agree. Can you elaborate a little bit more on, so let's just fundamentally talk about the difference between holding money in a bank and then like a custodian, a brokerage account, and the SIPC insurance?
Absolutely. Yeah. So so what are the limits on SPIC? So FDIC covers banks. And then for example, we use Fidelity EWA. I personally, EWA manages my money. It's all at Fidelity, right? So, and we have Charles Schwab as well, a new custodian that we've introduced. So both of these are huge custodians. Fidelity has $8 trillion of assets. And so if I have my money there, let's talk about what's safe. SPIC, what does that cover from a cash perspective, from an investment perspective? And let's just go catastrophic. Like what if Fidelity goes under? What kind of protection do they have for our clients?
So SIPC covers the same $250 of cash and then an additional $500,000 of securities. So most brokerage firms, custodians, they'll insure $750,000. Fidelity, however, they are insured through Lloyd's of London on top of that. And so they will insure up to $1 billion per client. So 1.9 million of cash, that 250 bumps up to 1.9, and then total securities up to $1 billion. So
if they go under, they have an insurance policy that kicks in and pays up to $1 billion to each client to make them whole.
Yeah. And so it's a couple of things on that. Fidelity is now over $10 trillion of assets. And so if Fidelity goes down, personal opinion, there's going to be,
bigger circumstances to worry about.
That's like absolute doomsday worst case scenario.
So let's talk for a second about, we've covered cash in the bank and we've covered cash, at a brokerage house that's SPIC insured. So higher level of protection, if you're with a brokerage house that's purchased that additional insurance. You mentioned 1.9 million. At Fidelity, I believe Charles Schwab is the same thing as 1.9. What are they? Do you know that offhand? We'll put that in the show notes. I know they have excess insurance. I'm not sure how much. Okay, so cash. There's no difference between cash in a bank or cash at Fidelity, assuming you're under those limits. So then let's talk about. We've covered the inflation risk. So let's talk about what do banks. I've heard that if you give $1 in a checking account to a bank, the bank is doing up to 7 different things with that money. So, for example, they're lending that money out to your neighbor for their mortgage. They're using that money to purchase treasuries. They're doing all other sorts of creative ways to get the money working for them. They're paying you maybe 1%, and they're probably making 6 or 7% on that money, hypothetically. So, in light of what just happened. And with interest rates going up, if you want your money to be safe from an institutional level, we've talked about the FDIC, we've talked about the SBIC, we've talked about brokerage accounts that ensure higher levels, but why not just remove the middleman and just go purchase the treasuries yourself? I mean, you can get a 3-month, 2-year treasury paying above 4% right now. If you have $1.9 million you want to have cash, just go purchase the treasuries. Because one, it's guaranteed from the custodian from the brokerage level. And then it's also, there's nothing safer than the United States government, the U.S. Treasury bills themselves. So if you want to know what's safe that you can cover as many risks as possible from an inflation and actual, like the ships falling down, the Treasury bills would be the answer.
Yeah, I would say that's like any liquidity needs. So if you're not going to need the money, long time horizon, put it in the, generally invest it, get it in the stock market. We know we're buying stocks at a discount. We know it's going to go up over time. Treasuries are great. We've helped a lot of clients with any short-term liquidity needs in the next 5 years, we'll say, because you have to pick that duration, 3-5 year treasury. And so that time period makes a ton of sense. Put it in treasuries, getting a very high rate of return right now, given interest rates, and it's going to outperform cash all day.
Absolutely. So, okay, now let's move into then some other, generally speaking, I would say our clients, we actually looked this up before the podcast, but clients that we invest their money now we work with young physicians, we work with retired physicians, we work with retirees, executives all across the map. But if you just look at the average portfolio that we manage, it's about 80% equities, 20% fixed income. So a lot of our clients are committed to being long-term equity investors. And this is our belief is how you can save time and true wealth is created, because equities are very volatile and short-term, but we would never recommend a client put short-term needs in equities. You should never have money in the stock market if your time frame is under 5 years. So if the assumptions are you're building long-term wealth, you have short-term liquidity needs taken care of, then we don't need to be talking about cash. We don't need to talk about treasury. We don't need to talk. You should be diversified and in equities with every dollar above those safety net figures. And so with that, again, the custodian comes into play, the SBIC comes into play. Technically up to $1 billion at Fidelity, we cover it as an individual client. So then there is the risk of, the volatility in the short term. There's a risk of loss, but that loss is only a loss if you realize that loss. And if you have a good financial plan in place and you're never in the position where you have to sell something at a loss and your time horizon is there's a strong probability that equities long-term will be your safest bet from an inflation reduction strategy. Equities have consistently outpaced inflation. And then also from a liquidity standpoint, the majority of our clients have line of credits attached to their non-qualified investment. So if you have $1 million in a taxable brokerage account backed up by the SBIC, a lot of banks, or we use Goldman Sachs as one example, will give you half of that money back in liquidity right away. And so that means if you're a client with $1 million invested and the market's going down like it did in 2022, you don't have to worry about paying taxes if liquidity concern. You don't have to worry about market timing. You can borrow the money from Goldman Sachs. Goldman Sachs knows if you go bankrupt personally, they have collateral on that account. But that strategy allows you to keep your investments long-term, never touch them, never worry about taxes, never worry about market timing. And then on a bad year, or if you have a liquidity need, you still have access to the money without actually disrupting the portfolio. So we do recommend address cash needs, any purchases in the next 5 years having cash. address your emergency fund needs, address your peace of mind philosophically. What do you need that's safe just so you can sleep at night? And then anything above that, let's get it working long-term to outpace inflation, but let's also keep it available. Let's keep it liquid by having that secured line of credit. That does not cost anyone anything unless they actually use the money. Then they're paying interest until the loan's paid off, but they can just do interest only. But that's avoiding taxes, avoiding market timing, and usually it's a short-term need. They're popping money out and then putting it right back in.
Yeah, no, I couldn't agree more. I think that's very well explained. And then just to tie a bow on it, like we always tell clients, bonds, cash, anything short-term is for financial planning purposes, meaning, if you want to kids going to college in the next 5 years, have your bonds intentionally that it's there, have your cash, whatever we decide on. And then the other thing with the line of credit, I think what's really important about that too is it makes a ton of sense when you have high income earners that, there's never any question that like money's coming in that could pay that off. And it just immediate liquidity solves a problem without having to sell any equities at a loss or realizing any capital gains.
Absolutely. Well, let's delve into more in a financial planning standpoint. So interest rate risk is a huge thing if you're in the distribution phase. So, traditionally, like if you're a retiree in a 60-40 portfolio, so 60% equities, 40% fixed income, what happened in 2022 is equities went down, 20%, and bonds also went down 10 to 15% as well, because what happened, again, your bonds, you weren't losing money if you could see the duration, but you saw the portfolio decline because if you had to liquidate those bonds that year, the purchaser of that bond would be accepting a lower rate from you than they could get on the marketplace. So there would be a loss of a principal at that point. So, typically we recommend a retiree, just an example, if you need $100 a year of income and $50,000 is coming from Social Security between you and your spouse, the other 50 needs to be taken out of a portfolio. We'd recommend a 7-year backup. So 7 times 50,000 is safe. So that'd be, if you're $1 million portfolio and you're retired and you need 50 a year coming out, we'd recommend 350 of that be safe. And then 650 of it could be in equities, because there's no time historically, and history doesn't, prove anything for the future, but it's a good way to plan financially. There's no time where the markets, equities from a diversified perspective would have gone down, taken that long to come back up. So you could have, distributed the safe money and let the equities recover in the worst case scenario. But what 2022 shows us is that safe money can't just be in bonds, because bonds have interest rate risk. So, typically our retirees, we recommend to have a 12-month liquidity plan. But then cash value inside of insurance contracts has actually become extremely useful, because this type of safe money does not have interest rate risk. So for a retiree right now in 2022, if all they had was bonds, that would be a mistake, because they would have had to sell those bonds at a loss in 2022. But if they had some cash or very short-term bonds or cash value in the insurance, that would have really saved the day. And then those intermediate bond durations could have been held to maturity. So then again, the goal of any money, and this is a Warren Buffett code, is never lose money. But you need to have a financial plan that puts yourself in the position to never lose money. And so we need to think about, where's our safe money? What is liquidity? What are all these ramifications that come into play? So, ideally, if I were to pick and choose a retired client, what makes up those 7 years? We'd want 1 to 3 years in a cash asset that's has no interest rate risk and no principal risk. And that would either be cash with no duration attached, or cash value inside of life insurance, because the insurance company will let you borrow that money, and there's no ramifications of what interest rates are doing in there. So typically out of 7 years, 1 to 3 years in an instrument like that, and the other 4 or 5 years in actual bonds, because that allows you to have 2 or 3 years as some of the bonds are maturing, to not ever risk the interest rate coming into play, if that makes sense.
Okay, a couple questions for you. That was all really well said. So 2022, one of the most unique years in equity and bond history. Like, they both performed very poorly. And so generally, if equities drop, bonds will work inversely, and investors flee to the bonds that have held their value. Didn't happen in 2022. So that makes the importance of having these other, whether it's treasuries, line of credit, cash value, all of these other avenues, that just reiterated why those were so important. And then the second thing, can you go into I think it's really important to understand, investing in a bond, what's the difference between a government bond and a corporate bond? And then like, let's just say, talk about the safety of a corporate bond or the safety of a government bond versus like if a corporation goes bankrupt, how safe is that corporate bond?
Yeah, no, absolutely. So let's just say hypothetically, Apple or Verizon, company Walmart, they issue bonds. You have 100,000. You let them borrow your money. That's what a bond is. You're letting them borrow your money. In return, they're going to say after, let's say 2-5 years, they put a duration to that. We're going to return your 100 grand. But while we have that money outstanding, we're going to pay you interest. Mm-hmm. If that company goes bankrupt, bondholders have some top rights. They get paid out first before stockholders. So there's a probability you'll get your money back. There's also a probability where things are really bad, you don't. Everyone loses. But a bond issued by the government that doesn't have that risk. Yeah. Right? It's by the government. The government goes under, then we have much bigger issues. America will still exist if no offense, if Verizon goes under, for example. It'll be in trouble because that means the economy is probably heading south. But the government obviously isn't going anywhere. And just a quick to address that a lot of people say, the government's in so much debt. The American assets, if we add up the amount of assets Americans have, it is over 3 times the amount of debt that the U.S. owes to China. Statistic. So if you look at, I believe the debt's crazy. It's like over 30 trillion, I believe.
Yeah, 30 something.
The amount of assets individuals in America hold are over 3, almost 4 times that amount. So when you look at, is that an issue? Yeah, that's not good. But in reality, like there is a strong backing of individuals behind that, of the actual assets. Yeah. So, okay. So philosophically, that brings us to, what bonds are the best. Typically, we're looking at we want our bonds to act as safe money to allow our equities to be invested long-term and get us our returns. But depending on account, the municipal bonds are also, by municipalities around the country, very attractive from a tax perspective because they're federally tax-free. So if you're in a high income tax bracket earning 5%, that 5% doesn't get hit with federal tax. Depending on the state you're in, if you're investing in a different state, you could still pay state taxes. If it's the state you're in, then generally they're exempt of state taxes. But, consult with your CPA and we got to look at each one individually in your situation where you're a resident of to figure that out. Federal treasuries are taxable from a federal level. And corporate bonds are taxable at a federal and state level. So corporate bonds generally have to pay the highest interest to make up for the fact that they're the most tax inefficient. Treasuries are second because they're just federal, and then municipals are the best tax-wise because federal is usually your highest tax bill, and municipals avoid that federal tax. So there's a tax ramification to figuring out the returns. So a corporate bond paying 5% may actually be worse than a municipal bond paying 4% because of the taxes. But then you also have to look at the safety of each one as well. And generally speaking, treasuries are by far the safest, and then corporates and munis following that as well. So
basically, just to sum up everything you said, corporate bonds, a little bit more risky, but in return, you get a higher rate of return, taxed inefficiently. And then municipal bonds, the difference is safer, lower rate of return, tax-free, essentially.
Exactly.
Okay. No, that's great. So then talk a little bit about, we read a pretty detailed research report on the standard deviation between stocks and bonds long-term.
Oh, this is phenomenal. I'm going to just back to you because you actually did a video on this 2 years ago. So think about what's safer, stocks or bonds. Ask the general public is going to say bonds, which is true. But you need to put the context. So you say, okay, which is safer this year? It'd be bonds. Which is safer in a 5-year? It'd be bonds. But when you say which is safer, stocks or bonds, if you have a 30-year period, what do you think people would say? Probably say bonds, but it's dramatically different. And explain this to us.
Yeah, I mean, basically, if you think about it, just like from a macro level, like the stock market, if you're diversified appropriately, is pretty predictable long term, right? Like if you're properly diversified, it's going to go up over the longer the time horizon, the more you can almost say with I guess say with a high probability that it's going to increase in value.
S&P 500, if you reinvest the dividends over the last 100 years, has been north of 9% compounded rate of return. So, rule of 72, your money would double every 8 years.
And again, if you are properly diversified, if you're in the S&P 500 index fund, yes, there's a company that's in the S&P 500 today may not be in the S&P 500 20 years from now, but if you're properly diversified, whatever company slots in, you're invested in. So, that risk is covered. Bonds, however, there's so much interest rate risk, and interest rates fluctuate so often that the long-term safety or standard deviation is higher in bonds versus equities because it's much less predictable over a long period of time because nobody has any idea what interest rates are going to be 20 years from now.
Absolutely. So if you actually compare the return over, and we'll put this video, the links in the show notes. If you look at the returns over trailing 1, 5, 10 years, and then look at the standard deviation. So basically return is the return, the standard deviation is the risk. Stocks were riskier, higher returns, but also higher risk than bonds. But if you look at those longer time periods, stocks were highest returns by far, but also lower risk than bond. Because if you have a 30-year bond, the chance of interest rates fluctuating over those 30 years is crazy. If you need to go sell that bond within that 30 years, there's a high risk of losing a lot of principal, or the high risk of there's also upside of you selling it at a gain. It just depends on where interest rates are higher or lower when you purchase the bond. Whereas the stocks, it's pretty consistently, there's going to be very scary, 20, 30, maybe 50% dips along the way, but long term, it's the stock market rewards patient investors. And I love the quote. It's a place where impatient investors transfer wealth to patient investors. So we'll put that definitely in the show notes. So let's dive into the cash value of insurance companies. So first of all, there's a type of, there's so much misinformation about life insurance out there.
I think this is very misunderstood. There's a lot of a lot of people don't truly understand how this works.
Yeah. So we're not talking about like index, universal. There's a lot of and we'll probably have episodes just on this, a lot of extremely, I don't know just use direct words, garbage products out there. They're designed to maximize profits of the company or the agent selling them. They're not going to do the clients any good. So what we're talking about right now is, most listeners, especially if you're just generally speaking, under a Roth IRA limits, married filing joint, under 200,000, let's say, life insurance, you should just be buying term insurance and invest in the difference. Very, very simple. But if you're a high net worth, making over $500,000, $1 million a year, or have a net worth of, let's say north of $5 million, the life insurance can be a big estate planning tool, a big safety tool, but it can also be a place where ultra high net worth people store cash, because in a whole life insurance contract specifically, the contracts have a guaranteed cash column. And how this works is the company has to keep reserves in place to honor those reserves. So if you look at, some of the biggest mutual companies out there, companies like Mass Mutual, Northwestern Mutual, New York Life, Guardian, these are monster companies, billions and billions of dollars of portfolio. They've existed for 100 years and they pay dividends every year. They're mutually held, not publicly held. And the cash value inside these contracts are literally guaranteed. So if they go bankrupt, that cash has to go to you, but most likely a company like this wouldn't go bankrupt. They would get bought out, and the company buying them as part of the transaction have to make the policyholders whole. And so the nice thing about these contracts, again, not recommending them, just talking about the safety of them, is that every year when a dividend is paid, the dividends aren't guaranteed, but when the dividends are paid, you have a guaranteed cash column and then a non-guaranteed, but the non-guaranteed column transfers to the guaranteed column every single year and it vests. And it's one of the only asset classes that exists where it has the upside, but every year it vests, meaning if the market goes down 2022 by 20%, the cash in there it goes up. It can never go down. And the other nice aspect of this from a financial planning perspective is that this is cash that, historically net of expenses in the companies we just named has averaged, net of expenses 4 or 5% actual cash returns. And so being able to get that and accumulate safe money, but also having it available to you, they'll charge you interest if you take it, but it's available without interest rate risk. You can go grab it if you have $100,000 in a bonds in 2022 and you need 100 grand, you'd only have 85 grand hypothetically if it's a corporate bond. If I have 100 grand in an insurance contract, I can go borrow that 100 grand, wait for the market to recover, and then go pay it back, and then nothing's changed. Or you'd have actually had to take a loss in that example. I wouldn't. Mm-hmm. That's why this can be an important part of and it is a very safe asset just with how these insurance companies are regulated and also how they manage their balance sheets. And one thing to look at is there's a reason why Warren Buffett, some of his most profitable holding companies, Berkshire Hathaway, are insurance companies. And if you think about a life insurance company, you want to look at a company that has, 100-year track record of paying dividends. You want to look at a company that has no debt on their balance sheet, just an amazing balance sheet, a safe balance sheet. You also want to look at the future block of business. So if you think about an insurance company, what's their risk? Well, if all of their policyholders die the next day, that really is tough for them because they have to pay all these death claims. But then if you think about the insurance company, if they're also offering annuity contracts, which is the opposite, annuities pay until you die. So if you're an insurance company and you're offering annuities, ideally you don't want your clients to live that long. But if you're offering life insurance, you want your clients to live forever because then you're delaying that big death benefit claim. So if you have both of these books of business, you're really diversifying your risk as an insurance company. And so, most clients of an insurance company, they have multiple products. And so if you think about, well, if they die too soon, the insurance company is losing money by paying the death benefit. They're also gaining because they can stop those annuity payments. So insurance companies are really set up, if you're part of a mutual company and you're investing your money there at 4 or 5% rate of returns, but getting that on a tax deferred basis and also with being able to access the money in the whole life insurance contract without interest rate risk. I can't tell you from a financial planning standpoint how key that is. If you're comparing or looking at like Dave Ramsey or Susie Orman, buy term, invest the difference. Yeah, all day for most of the general population. I'm going to say like 90% of the population should never mess with this stuff. Mm-hmm. They should be buying term insurance, investing the difference in Roth IRAs and letting the money grow. But if you're a high net worth person that have maxed out all the avenues, maxed out Roth IRAs, maxed out 401ks, and just want safe money, this may be one option to put it in. And most states, it's also asset protected. So if you're a doctor getting sued, money in your bank can be looked at. This could be covered through umbrella policy planning and other stuff. But most states, the cash value in life insurance isn't touchable if a creditor comes along. So that's another important aspect as well. Yeah. So Jamison, let's wrap this up. And a popular option is through this company called TIAA, and they have this traditional thing that is a guaranteed thing that they advertise, which it is guaranteed. But I want to talk about and some clients have liked this, and whenever we call and clients are retiring, getting their money out, TIA always puts up a pretty substantial fight on the phone with clients. I want to talk about let's just talk about the pros and cons of this TIA traditional sense. First of all, tell us about TIA. I know you do a lot of research. What is TIA? What do they stand for? And then let's go specifically into this guaranteed product.
So, I was on a call yesterday with a client. I've done this 100 times. And so it's, a high level TIACREF, it stands for, and I'm not saying this is good, bad, right, or wrong, but just fundamentally, I truly did not know this when I started doing this. It stands for Teachers Insurance and Annuity Association. So they are an insurance company. Their business model is insurance and annuities, meaning they're compensated based on their products of insurance and annuities. So that's awesome if you want to purchase
That's
an
their
annuity.
holy grail. That's their bread and butter.
That's great if you want to purchase an insurance or annuity product, but I think a lot of this gets disguised as an investment and part of your investment strategy, and as much as it very well could be if you needed that. I found a lot of people have these products that absolutely do not need an annuity. They have a pension, Social Security, and let's just fundamentally think about Teachers Insurance and Annuity Association. Most teachers have state pensions that are getting state of Pennsylvania. They have state pensions. Why would they ever need an annuity on top? Maybe they do, but generally speaking, they probably don't. So these contracts there's a number. I was looking at this yesterday. I think there's 6 different options they have, and we're gonna look at one example. But the pitch is it's a lot of times these are within 403Bs. So let's say you have $1 million inside of a 403B that you've accumulated if you work for a hospital. Yeah, let's just say a hospital, for example, because this is where I've seen it a lot. So if you work at a hospital, you're not a teacher, so you still have this annuity contract, but you have $1 million in a 403B, and 200,000 of it you could not even know, but just based on the investments that are within that $1 million, let's say 200,000 of it's in one of these TIA traditional guaranteed funds is what it's called. So if you don't do your research, you're gonna have no idea what that is, which is most people do. And so TIA will pitch it like, hey, this is a safe guaranteed asset, meaning you put this in, we're guaranteeing, I have the fact sheet right here on one of these, like 10-year rate of return is 3.37%. So they're saying like, hey, this is safe, this is guaranteed, it is an annuity contract. And then you look down into the fine print, the returns based on the 5-year constant mature 5-year treasury rate less 125 basis points. That's how they're coming up with, however they calculate the annual rate of return.
Can I stop you right there?
Yeah, go ahead.
Why not go purchase a 5-year treasury minus 0 basis points?
Yeah.
Treasuries are free for anyone to purchase.
Exactly. And
Why
so
not
then the
just go
caveat with these things, why we don't generally recommend is...
Can I ask you this before? What is the main purpose of having safe money?
So it's liquidity.
Liquidity, so you can use it when?
Whenever you need it.
Whenever you need it. Can you use TIA money whenever you need it?
It is depending on the contract, I would just say majority of them, they're paid out over 10 years.
So I have $1 million in a TIA guaranteed thing, and I need it. I'm going to call them up, and they're going to say, we can give it to you over 10 years.
Yeah.
We'll give you 100 this year, 100 year 2, 100 year 3. So we've just literally, it feels good, it's safe. We've just defeated the purpose of having safe money at all. It's there when the market's down, like 2022, you need to be able to access it. So what is the point?
Yeah.
In my opinion, there is no point. And again, just being based upon 5-year treasury less 1.25%, you basically have a treasury portfolio that your advisory is charging 1.25% for.
Yeah,
that is robbery.
That's criminal in itself. And I was on the call doing a rollover yesterday, and basically unwinding this. The client didn't even know what he had, and they're pitching. They're like, "Hey, do you have a spouse? Like, this is going to be, if you pull this out, you could lose the income for life." Like, this guy's like trying to pitch this on the phone. It's like, well, he doesn't need an annuity. He has safe money elsewhere. Like, we just fundamentally don't need this.
Crazy.
Yeah, but so anyway, a lot of the safe products, do your research, make sure they're safe. And then annuity contracts, we'll probably do a whole nother episode on that. The annuity contracts, annuities fundamentally, in our opinion, should absolutely not be used in the accumulation phase. They're too expensive. You're not participating in stock market upside. And if you're in an annuity in the accumulation phase, not going to make a general recommendation, but most likely I would say most cases we've seen, you shouldn't be in that. And then potentially you could be in an annuity contract in the distribution phase. Haven't seen a ton of situations where that even makes a ton of sense. And I've seen very passionate about the
and so annuities, like if it's an annuity is meant to be a tool for a retiree to distribute income. And so we do have many clients that have income annuities that have 20-year guarantees. If they die, their spouse gets it. Their spouse dies every 20 years. But that is part of a financial plan to bridge the gap, because these clients don't have pensions. They have Social Security. So this is just to bridge the gap. So all their necessary expenses are covered, and the portfolio can cover the gaps of the rest. And that allows them to be a more aggressive equity investor as well. So I think the whole context of this entire podcast episode is, what's safe factually and logically out there. But more importantly is, how do you use this information to formulate a financial plan that works for you and your family? Because we've seen so many balance sheets that clients are living their lives based upon what their balance sheet does. And I think this is a catastrophe. Every financial plan, our humble opinion, your money, your balance sheet should be set up to support your life by design now, next year, 3 years from now, when your kids are in college, when you retire. It's just a simple tool. It's a support mechanism that's supposed to take stress off your plate, not add additional stress onto it. And with the misinformation out there, and what the purpose of this podcast is financial literacy, education, power, information is power, will allow you to make the best decisions for your financial plan to support your family and make sure that all of your goals are being met.
One thing to add, I think I read this statistic the other day. Over 60% of American households say that finances are their number one stressor in their life. And so, I mean, that's very, like, people live their life based on what their balance sheets are or not doing. And our goal is to reverse that, give financial literacy back so people can live their life, make the decisions they want, do the things they want, and not worry about what their balance sheets do.
And I would say there's no easy button. Like, even our clients, we focus so much on education because, like, we're the CFO, they're the CEO. Yeah. They obviously, but if there's not education and we can't navigate them through a down market, they're like, no, I want out. The big mistake could happen. So as a client, we do recommend you have to have some general knowledge base and financial literacy for the relationship with an advisor to be maximized, because then you can orchestrate and truly delegate stress-free. Because if you have no idea what's going on, you may have all the trust in the world with someone, but if you don't understand it, you may even be more stressed and then not trust that person when you disagree and don't understand something. So our goal here is, financial literacy is so key, but it's just one part of the equation in starting a relationship with an advisor that they can truly save time and help you live your best life. Thanks for tuning in to our podcast. Hopefully you found this helpful. Really hope this is as beneficial and impactful to as many people across the nation as possible. So hit the follow button. Make sure to rate the podcast, and please share with any friends or family members that would also find this beneficial. Thank you very much.